Hey everyone, and welcome back to Everything About Accounting. Following up on our explanation of debits, today we're diving into the other side of the accounting coin, credit. In accounting, a credit, often abbreviated as CR, simply means an entry on the right side of an accounting equation or a T account. Just like debits, a credit isn't inherently good or bad. Its effect depends on the type of account it's applied to. Again, let's think of the basic accounting equation. Assets equals liabilities plus equity. Generally, credits increase liability accounts, like accounts payable and loans payable, and increase equity accounts, like owner's capital and retained earnings. Conversely, credits decrease asset accounts, like cash and accounts receivable, and decrease expense accounts, like salaries and rent. So, you see, credits have the opposite effect of debits on the main account types. Remember, in double-entry bookkeeping, every transaction involves at least one debit and at least one credit, and the total debits must always equal the total credits. This keeps the accounting equation in balance. Debits and credits work together to record the flow of economic activity within a business. Understanding how they affect different accounts is fundamental to understanding how financial transactions are recorded. So, to summarize, a credit is simply an entry on the right side of an account. Its impact, increase or decrease, depends on the type of account it affects, and it always has an equal and opposite effect to a debit in the same transaction. There you have it, credit explained in under 90 seconds. Hopefully, understanding debits and credits together makes more sense now. Let me know in the comments if you have any further questions. And don't forget to subscribe for more quick and easy accounting lessons. What key accounting process should we explain next? Thanks for watching, and I'll see you in the next video.